We shall now commence this module by studying the meaning, nature and concept of market value. Market value. The term market value refers to the price an asset will fetch were it to be sold. This price is not necessarily equivalent to what the asset was purchased for, only what it is worth now. Since assets can fetch different prices if sold in different locations, an asset can have different market values in different markets. For the purposes of investors, this value will usually be restricted to the value within a single market. According to David Maloney, market value is an all-encompassing general concept that is based on a market perspective as opposed to a user's perspective and on what marketplace participants view as typical and normal market conditions. Market value is the price an asset will fetch in the marketplace. Market value is also commonly used to refer to the market capitalization of a publicly traded company and is obtained by multiplying the number of its outstanding shares by the current share price. Market value is easiest to determine for exchange traded instruments such as stocks and futures, since their market prices are widely disseminated and easily available, but is a little more challenging to ascertain for over-the-counter instruments like fixed income securities. However, the greatest difficulty in determining market value lies in estimating the value of illiquid assets like real estate and businesses, which may necessitate the use of real estate appraisers and business valuation experts respectively. Market value, as noted earlier in the module USPAP, only describes market value as a general concept but does not define market value. Market value is defined as the most probable price which a specified interest in property is likely to bring under all of the following conditions: consummation of a sale as of a specified time, open and competitive market for the property interest appraised, buyer and seller each acting prudently and knowledgeably, price not affected by undue stimulus, buyer and seller are motivated, both parties acting in what they consider to be their best interest, adequate marketing efforts made and a reasonable time allowed for exposure in the open market. After studying this module, you shall be able to know the meaning of market value, evaluate the difference between market value and fair value, understand the different normal and typical conditions for market value, know the significance of market value, learn various techniques under IFRS 13, understand when lower of cost or market value is applied. Now, let us discuss the market value concepts and comparisons. Market value requires normal and typical marketplace conditions. Marketplace must reflect what is normal and typical within the marketplace, that is geographically relevant to the property subject in question. If the conditions of a particular market value assignment are not normal and typical, then the term market value shall not be used. Conditions are not said to be normal and typical under the given situations: if there is an urgency to sell, if the seller is not a willing seller, if the buyer is desperate and feels an urgency to buy. In such cases, the term market value is not appropriate to use. In short, market value pertains only to values developed from the market perspective when assignment conditions are normal and typical. It is pertinent to note that in AO 22 USPAP it is clarified that one shall not use the term market value alone if the definition of the type of value being developed by the appraiser includes conditions that are not normal and typical. Conditions are said to be normal and typical under the given situations: reasonable exposure time, arm's length transactions, buyer and seller knowledgeable of the relevant facts, parties acting in their own interest. Price is in terms of cash. Price is unaffected by creative financing or concessions. Significance and characteristics of market value. There are several valuation concepts, but market value has its own significance. It is considered as a most probable price. There are bona fide buyers and sellers, and transfer of title takes place. These have been briefly discussed. Market value is an opinion of the most probable buy-sell price. It reflects the probable amount, which is the most probable price of money a buyer would pay and a seller would accept for an item of property under specific conditions. The most probable price in terms of money which a property should bring in a competitive and open market under all conditions requisite to a fair sale, the buyer and seller each acting prudently and knowledgeably and assuming the price is not affected by undue stimulus. Third, there is an actual bona fide buyer and seller. Fourth, a transfer of title will take place. Fifth, the title to the property will transfer as of date certain. Sixth, it is more indicative and realistic. Next, fair market value. In certain situations, the term fair market value is used rather than the term market value. Let us now understand what this term means. Fair market value is a specific type of market value. It is defined by a legal or regulatory jurisdictions and varies with individual jurisdictions. For federal uses such as estate and gift tax or charitable contributions, fair market value is defined by Treasury regulation as the price at which property will change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or to sell and both having reasonable knowledge of the relevant facts. Let us now understand the difference between market value and fair market value. We have already learned about the meaning of fair value in the previous module. Now, we will understand the difference between the two terms because the term market value is often used interchangeably with fair market value, although these terms have distinct definitions in different standards and may differ in some circumstances. First, fair value can be clearly distinguished from market value. It requires the assessment of the price that is fair between two specific parties, taking into account the respective advantages or disadvantages that each will gain from the transaction. Although market value may meet these criteria, this is not necessarily always the case. Second, fair value is frequently used when undertaking due diligence in corporate transactions where particular synergies between the two parties may mean that the price that is fair between them is higher than the price that might be obtainable on the wider market. On the other hand, market value requires the element of special value to be disregarded, but it forms part of the assessment of fair value. Third, when determining the value of assets, a synonym for market value is sometimes used incorrectly in place of fair value. The term fair value refers to the price that a party should pay for an asset which may or may not reflect its fair market value. Third, market value presumes the transfer of property as of a certain date and under the above noted typical and normal assignment conditions. Moving on to the fair value versus market value. There are two schools of thought, namely the efficient market hypothesis and the behavioral finance hypothesis, based on which the concept of market value and fair value can be compared. First, both schools of thought are about the relation between the market price and fair value in any kind of market, but especially with regard to tradable assets. The efficient market hypothesis asserts that in a well-organized, reasonably transparent market, the market price is generally equal to or close to the fair value as investors react quickly to incorporate new information about relative scarcity, utility or potential returns in their bids. See also rational pricing. Behavior finance asserts that the market price often diverges from fair value because of various common cognitive biases among buyers or sellers. However, even proponents of behavioral finance generally acknowledge that behavioral anomalies that may cause such a divergence often do so in ways that are unpredictable, chaotic, or otherwise difficult to capture in a sustainably profitable trading strategy, especially when accounting for transaction cost. Second, fair value. When an asset changes hands, its value changes in many situations. This is because the new owner may be able to fetch a higher price or leverage certain efficiencies that result from a transfer of the property. Alternatively, the asset may become worthless if it changes hands. Therefore, while deciding the worth of an asset, an investor may attempt to calculate its fair value, meaning how much a party is wishing to buy it for. This fair price depending on how much it is worth to the party who is buying it. For example, if a painting in auction is sold for Rs 13,000 with the relevant cost involved in price of painting in auction. First, amount if actual sold. Hammer price Rs 13,000, insurance Rs 100, shipping Rs 200, 10% seller commission Rs 1300, amount received by seller Rs 11,400. Second, amount if hypothetically sold. Hammer price Rs 13,000 plus 10% buyer's price Rs 1300, hypothetical amount obtained Rs 14,300 FMP. Here, the FMV is not Rs 11,400 amount that is retained by seller, but Rs 14,300 hypothetical amount obtained. Third, an asset's fair value is often equivalent to its market value. For example, if one company purchasing another company would not have a special advantage or disadvantage if it were to sell that asset right away, and both companies can freely sell the asset on the open market, then the fair value for the asset is the same as its market value. However, more often one company will hold a slight advantage, meaning the values will differ. Fourth, both of these terms are frequently used by investors and businesses while attempting to determine a company or other entity's total worth. Often, when the entity's assets may soon be bought or sold, when an investor is valuing a company, he will generally look only at its market value. However, if he must consider how the price of an asset will change if placed in other hands, he will likely look at the asset's fair value too. Fifth, when a client wishes to know the worth of something, then definitely the client is asking for its market value. A common example is a homeowner wishing to know the worth of his house. By means of applying proper appraisal techniques and methodology during the appraisal process, an appraiser can answer that question with an opinion of the property's market value. Sixth, market value provides a baseline for negotiations. In case the clients decide to sell, depending on many factors, the client might decide to ask more or less than market value when attempting to sell the property. Thus, market value provides a basis for seller is ultimately willing to accept when selling. Let us now discuss the valuation techniques under IFRS 13. Valuation techniques under IFRS 13. An entity uses valuation techniques appropriate in the circumstances and for which sufficient data are available to measure fair value, maximizing the use of relevant observable inputs and minimizing the use of unobservable inputs. The objective of using a valuation technique is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability will take place between market participants and the measurement date under current market conditions. 3. Widely used valuation techniques under IFRS 13 are: first, market approach. This technique uses prices and other relevant information generated by market transactions involving identical or comparable assets liabilities, or a group of assets and liabilities. Second, cost approach. This approach reflects the amount that would be required currently to replace the service capacity of an asset, which is current replacement cost. Third, income approach converts future amounts, that is cash flow or income and expenses, into a single current discounted amount, reflecting current market expectations among those future amounts. In some cases, a single valuation technique will be appropriate, whereas in others, multiple valuation techniques will be appropriate. Applying lower of cost or market value to inventory. The lower of cost and market value method has two boundaries on the valuation of inventories. The first is the inventory ceiling, which requires that inventory must be reported no higher than the net realizable value less expenses. The second boundary is the inventory floor, which requires that inventory value be reported at no lower than the net realizable value plus normally attainable profit. Generally accepted accounting principles (GAAP) allow for the lower of cost or market rule to be applied in one of three ways. First, on an inventory total basis. Applying LCM to inventory totals is the least conservative application, since it results in the smallest write down or reduction of inventory from cost and the smallest loss on the income statement. Second, on an inventory categories basis. Applying LCM to inventory categories results in values that fall somewhere in between the other two methods of applying LCM. Third, on an item by item basis. Applying LCM on an item by item basis is the most conservative application, since it results in the largest write down or reduction of inventory from cost and the largest loss on the income statement. We shall now understand the inventory valuation, US GAAP and IFRS. Under US GAAP, ASC 330-10 is the primary source of guidance on accounting for inventories. Under IFRS, IAS 2 inventories is the primary source of guidance on accounting for inventories. Both US GAAP and IFRS define inventories as assets that are held for sale in the ordinary course of business, used in the process of production for sale, or materials or supplies to be consumed in the production of inventory or in the rendering of services. The cost of inventory under both US GAAP and IFRS generally includes direct expenditures of getting inventories ready for sale, including overhead and other costs attributable to the purchase or production of inventory. IAS 2 includes specific scope exceptions for inventories held by producers of agriculture and forest products. Agriculture produce after harvest and mineral products to the extent that they are measured at net realizable value in accordance with well established practices in those industries, and inventories of commodity broker traders who measure their inventories at fair value less cost to sell. Under US GAAP, similar guidance is provided in ASC 905-330, which allows for measurement of inventories at net realizable value in certain circumstances in the agricultural industry, and ASC 940-320-30-2 and ASC 946-10-15-12, which allow for measurement of certain inventories at fair market value in the financial services industry. Let us now recapitulate what we have learned so far. The term market value refers to the price an asset would fetch were it to be sold. This price is not necessarily equivalent to what the asset was purchased for, only what it is worth now. Since assets can fetch different prices if sold in different locations, an asset can have different market values in different markets. Market value must reflect what is normal and typical within the marketplace, that is geographically relevant to the property subject in question. if the conditions of a particular market value assignment are not normal and typical, then the term market value shall not be used. There are several valuation concepts, but market value has its own significance. It is considered as a most probable price. There are bona fide buyers and sellers, and transfer of title takes place. The lower of cost and market value method has two boundaries on the valuation of inventories. The first is the inventory ceiling, which requires that inventory must be reported no higher than the net realizable value less expenses. The second boundary is the inventory floor, which requires that inventory value be reported at no lower than the net realizable value plus normally attainable profit. Under US GAAP, ASC 330-10 is the primary source of guidance on accounting for inventories. Under IFRS, IAS 2, inventories is the primary source of guidance on accounting for inventories. Both US GAAP and IFRS define inventories as assets that are held for sale in the ordinary course of business, used in the process of production for sale, or materials or supplies to be consumed in the production of inventory or in the rendering of services. The cost of inventory under both US GAAP and IFRS generally includes direct expenditures of getting inventories ready for sale, including overhead and other costs attributable to the purchase or production of inventory.